Hello and welcome to another 30-Minute Thursday. My name is Amit. It is 2 p.m. in the beautiful, wants to be spring, but still really cold Pacific Northwest. We are live on Facebook. Welcome, everybody. Bienvenidos. Estamos en vivo a la Facebook. Yes, I'm still working on my Spanish, slowly but surely, incrementally getting better every single day, practicing as best I can. You know what they say, practice. If it doesn't make if it doesn't make perfect, it makes permanent. But hopefully y'all can understand my Spanish, and more importantly, the people I speak Spanish with in Spanish-speaking countries will be able to understand it. So hope you guys are doing great. Hope everybody is staying safe, staying healthy, staying sane. Always an important thing to stay sane. It's almost St. Patty's Day. I don't know if you could tell, but there's some green in this shirt. I do love St. Patrick's Day. We've got a corned beef that we're going to be making tomorrow. Corned beef and cabbage, of course, with some potatoes. There will be beer, of course. I have to have something of the tradition, even though clearly I am not Irish. But St. Patrick's Day is a wonderful holiday, and to all my friends and all the Irish folks who celebrate it, I hope you guys have a fantastic celebration. With all that said, notice that it's really bright outside. I got to tell you, spring is starting to poke through here. The green shoots of spring are starting to poke through in the beautiful Pacific Northwest. And if you've never been here, there are a lot of rumors about rain and gloom and all that, and they are all true. But I will also tell you that when the sun does come out once every 6 weeks, it's glorious. And so as soon as I finish this broadcast, I'm going to hopefully get a chance to run some errands. I'll take my convertible, drop the top, put on a jacket because it is still really cold out there, and get some vitamin D and some sunshine. But for now, let's talk about what in the world is happening in the banking sector, in the economy, with mortgages, and my fingers don't work so well, and with residential real estate, which is all tied together. We're all connected. We're all interwoven. And these details are especially interwoven. So if you follow me on Facebook, and I imagine some of y'all do because you see me on this, so you know where to find me. I've been posting very small little reels, I think that's what they call them, or stories, or whatever it is, about what happened in the banking sector over the weekend and what's kind of manifesting right now in real time. And I want to take a deeper dive because these stories only give you like 60 seconds, and I can't even say hello in 60 seconds. So let me take a deeper dive with y'all and explain as best I can what's going on and what it really means, and what the potential risks are, because there's risk and there's problems. We are at the beginning of this problem. We have a long way to go. Yes, the Federal Reserve Board is working to reduce inflation, and hidden in all of the chaos of this week's worth of stories with the banks and with what's going on in Europe and other things, hidden in all that is this great revelation that inflation is in fact coming down. We had on Tuesday, I believe, don't quote me, but I think it was Tuesday. Tuesday, we had the Consumer Price Index. That came out, that was the 14th. And the Consumer Price Index is a measure of inflation that measures the cost of a variety of things that the consumer pays, obviously the Consumer Price Index, right? And it showed that inflation is holding steady. Every component that goes into the Consumer Price Index, so every item that we could spend our money on, whether it's cars, whether it's travel and hospitality, whether it's clothing, whether it's medical expenses, just about everything is showing a flat line or a decrease. The one sticky place is that cost of shelter, basically rents, which is a very, very lagging indicator, which means that when things correct, it takes months for that correction to actually be seen and felt in the markets. So that's a lagging indicator. But unfortunately, cost of shelter is like 43% of the entire index. So if that goes up a little bit and everything else comes down a little bit, it's still going to at least keep things even, if not bring them up. That is going to change. Really telling is that yesterday, the Producer Price Index came out. Now, the PPI is the cost of raw goods and materials that go into what we consume, whether it's clothing or textiles that go into our clothing, whether it's food, whether it's electronic equipment, whatever it is, stuff that manufacturers buy to make the stuff that we buy. That went down significantly. Now, sometimes those costs are passed on to the consumer, or those savings are passed on to the consumer. Sometimes they're not. That's a whole nother matter. But the cost of raw materials and goods that go into the things that you and I buy and consume, they're coming down, which means that inflation is coming down, which means that the Fed has done a job in bringing that inflation down. That should be a good thing, and we should be celebrating that. But unfortunately, the Federal Reserve Board has a habit. They are a chronic and serial overcorrector, and they are overcorrecting right now. And their overcorrection has caused and is causing real problems in other sectors of the economy. Remember, I've been talking with you guys about cooking as an example, because I do love to cook and I really love to eat. So this is something that's near and dear to my heart and to my belly. When we cook, for those of you who spend time in the kitchen, we season to taste, right? We taste it. Say, okay, it needs a little bit more pepper, or it needs a little bit more salt. Or my wife will ask me to taste something and say, what's it missing, right? This is how we dial in our recipes and kind of get what we want out of the meal that we're eating. We don't just dump an entire, thing of salt into the recipe and then say, oh man, it's too salty, I can't eat it. Like, that's what amateurs do. That's what people who don't know how to cook, that's how they do things. And they learn the hard way, of course. They learn that, like, that's not a way to go. Well, the Fed has, in essence, been dumping salt into the economy or into the recipe, and not really tasting it as they go. They just keep saying, hey, let's just keep more salt, more salt, more salt. They don't even know how much salt is in there. And eventually the meal can become unedible. You just can't eat it, right? Well, the same thing here. They're over seasoning and overcorrecting and overcorrecting. They're not even giving it time to kind of meld into the recipe and see what it tastes like before they throw more seasonings and spices in there, just because that's what they do. And that causes cycles. Boom and bust, boom and bust, boom and bust. And here we are on our way, sadly, to what could be called a bust cycle, or a bust part of the cycle. So what does that mean really? And how does it impact the world in which we live? Because we're all tied into this thing, whether you want to buy a house or not, whether you are comfortable with your mortgage or not, you're all in this. We're all in this together. So let me take you back a couple of years. I know it seems like a long time. 3 years ago, speaking of going back in history, 3 years ago, our government and the world in general agreed to shut everything down for 15 days to slow the curve, to slow the COVID spread. That was 3 years ago. I don't know if you guys remember that. I mean, I don't know how you could forget it. It's been such a monumental change in everything that we've experienced since then, but time flies and people get occupied with other things. But it was 3 years ago to the day, 15 days to bring down the curve, or to slow the curve, or whatever the mantra was. Okay. I'm going back a little bit after that. So in 2020, around that time, April of that time, May of that time, the Fed started buying a bunch of treasury notes and mortgage-backed securities. Mortgage-backed securities are the bonds that we create, the mortgage industry creates, when we sell your IOU, your note, to Fannie Mae and Freddie Mac. Fannie and Freddie securitize them, they bundle them up, and they sell them in the open market under what's known as a universal mortgage-backed security, a UMBS. And the Fed started buying those up with both hands, buying treasury notes and buying UMBS, in order to stabilize the economy, because we just unleashed this unprecedented halt on everything that happened. We just shut everything down, if y'all remember. And so they started buying, and they kept buying, and they built up a huge war chest of these things. In 2021-ish, the banks started buying these instruments as well. Now, keep in mind, these are supposed to be very safe financial instruments. This is a mortgage, right? We're underwriting mortgages. This isn't 2008, 2009, or the years that led up to 2008 and 2009. This wasn't like, hey, you can fog a mirror, here's a mortgage for you. We underwrote these things really, really well. And the default rate is minimal. Like the foreclosure rate, I talked about this a couple of weeks ago, almost zero right now. I mean, we really have done a good job as an industry in underwriting, and anyone who's worked with me or any mortgage lender for that matter knows we collect a lot of paperwork, right? It's not like, hey, here's some money for you because you showed up and shook my hand. We're going to underwrite. And so the instruments that these banks bought were very well collateralized and secure, as are the treasury notes that these banks invested in. Treasury notes is basically an IOU from the US government. It's from Uncle Sam. It's about as good as it gets, right? I mean, if the US government defaults on its IOUs, we've got a huge problem, right? Bigger than anything we've ever imagined. So these things are, as the old saying goes, it's as good as gold, right? So they bought a bunch of these things. I'm talking about tens of billions of dollars worth. Think about banks like Bank of America, Wells Fargo, Citibank, JP Morgan, Chase, in the recent headlines, Silicon Valley Bank. That might sound familiar. Signature Bank. That's another one that went under over the weekend that didn't get as much play. Silvergate Bank, also teetering on the brink. These banks, all these institutions, and it's not their fault, they bought all of these investments and they were collecting, they're getting the interest rates on those things was about 3% on average. I'm giving you guys the simple version, so bear with me here. So they bought these things at 3% interest. Cool, okay. And they're secure and they're getting their interest, right? No one's defaulting on them. They're collecting money. Awesome, no worries. So put that on pause and let's fast forward. Here we are in 2023, and we know what happened in the months leading up to 2023 and like 2022, the interest rates started going higher and higher and higher and higher. Why did they go up? Because the Fed allowed for inflation to rise. That's the bottom line. The Fed kept their short-term interest rates at close to zero until March of 2022. So up until a year ago, basically, the Fed rate was zero. And then inflation just like started eating everybody's lunch. And so the Fed overcorrected and they went from zero to like 5% in a year. It's unprecedented. It's really a huge overcorrection. They literally took the entire salt canister and shook it out into the recipe. And so what happened along the way is, yes, they are starting to deal with inflation. That's awesome. But as interest rates go up, understand that me as an investor, you guys as savvy investors, right? We can also invest in things that are paying higher interests. So if I've got money sitting in the bank, and I had money sitting at Chase Bank as an example, in a savings account, and Chase Bank was paying me 0.1% interest for the money that I had in savings. Now, I need a savings account. Yes, I like to have money in savings, but my savings basically acts as a loan to Chase Bank. I'm loaning my money to Chase Bank. And Chase Bank, let's just say I had $1 million in Chase Bank. I wish I did, not even close. But let's say I had $1 million at Chase Bank. They only have to keep 10% of my $1 million in my account. They're good for the other 900,000, but they only hold 10%. That's what the rules say. The other $900,000, they're out there buying mortgage-backed securities, or they're buying US Treasury notes, or they're buying whatever it is that they want, or they're making their own mortgages, and they're paying me 0.1% interest on my $1 million, but they're collecting 3% interest on the mortgage facilities, on the mortgage loans that they bought from the open market, from the universal mortgage-backed securities, or they're collecting 3% from the treasury notes that they bought from the US government. Great. So they're paying almost nothing. They're making 3%. that is a good return on that quote unquote investment. It's not even their money. I got wise. And I said to myself, well, gosh, if they can buy treasury notes at 3% in 2021, in 2022, and in early 2023, those treasury notes, I was buying them at 4.5%, in some cases 5%. So I took all my money out of Chase Bank, not all of it, but I took a lot of it out of Chase Bank, said, hey, give me my money back so that I can go buy better paying investments for myself. And I did, and yay me, that's great. A lot of other people did that as well. Now, here's where the rub happens. These banks, as I said, only keep about 10% of all of their depositors, all their depositors' money on hand. The rest of it is already invested. So if my theoretical $1 million, Chase took 900,000 and bought these assets a year ago, year and a half ago, and they've been collecting the interest ever since, and that's great. But when I need my money, and when a lot of other people came up to the bank and said, hey, give me my money back so that I can invest it elsewhere, they began to have a problem because they don't have all that money on hand. And that's where kind of the nucleus of this problem started. And that started, it's happening in other banks as well, but it became known fact at a bank in California called Silicon Valley Bank. And over the weekend, there was what's known as a run on Silicon Valley Bank, meaning that all of the depositors went to Silicon Valley Bank and said, give us our money back right now. We're freaked out. And Silicon Valley Bank simply did not have the cash on hand. So far, so good. I'm checking my time. I got about 13 minutes. I will speed this up. Silicon Valley didn't have the cash on hand. And so what Silicon Valley had to do, Silicon Valley Bank, what they had to do was they had to sell some of the treasury notes and mortgage notes that they bought in 2021. They had to sell them to liquidate them, to make them liquid cash, right? So that they could pay all of their depositors back. Not a problem, except, and here's where the Fed really did a number on all of us. Those 3% interest rate coupons, that's what it is basically, those 3% paying bonds. Why would I buy that from Silicon Valley Bank when I can buy them directly from the US government or from Fannie Mae and Freddie Mac at 5%? Because interest rates went up, right? So the price, the value of all of those tens of billions of dollars worth of bonds that Silicon Valley Bank holds, that Wells Fargo holds, that Bank of America holds, as long as they don't need to sell them and they hold them until maturity, no problem. But if you need to make cash available right now to pay all of your depositors who are like, give me back my money, give it back. If you have to make cash and you have to sell those assets, now you're selling them at a loss. And that is a huge problem because psychologically, the other depositors in the bank are saying, whoa, my bank is losing money. Where's my money right now? And how safe is it? Now, the FDIC insures our accounts up to $250,000 each. That's great. We're the consumer. Silicon Valley Bank had a lot, like 95% or 93% of all the money in that bank was held in accounts that belonged to companies, high-tech startups, venture capital companies, companies that had tens of millions, if not hundreds of millions of dollars in that bank that were not insured by the FDIC. Now, we can argue about whether or not the FDIC should insure them or should not insure them. That's a whole nother conversation. We need more than 30 minutes to have that conversation. But, I've got mixed emotions on it, guys. I don't have a formulated opinion just yet. But the problem is that if those companies, if Silicon Valley Bank went under and all that money got lost from all these companies, they stopped to make payroll. All of a sudden, they can't pay their vendors. And now we've got a bigger problem spreading through the system. I don't know if that problem could have been fixed or could not have been fixed. I don't know. I'm just not that smart, quite frankly, and we're projecting into the future. But what did happen was the FDIC and the Federal Reserve Board, God bless them, they stepped in to backstop the entire thing, meaning that they just created out of thin air a $2 trillion facility to help all these banks that bought these assets when they were good because they were not risky assets, but variable change happened, things happened, the interest rates went from 3 to 7, and all of a sudden these 3% bearing interest, 3% interest bearing coupons, they're no longer desirable. Now these are toxic. Oh yeah, they're safe, very, very safe, but they're toxic. No investor wants them because I could get 7% or 5% or whatever, but it's more than 3%. So why would I give you money for something that's less when I could get more? And that's what's happening. And now that the cat is out of the bag, everybody is looking at all of these banks, Bank of America, Wells Fargo, and a bunch of other banks to see what sort of exposure they have. Now, the banking rules, I'm checking my time, we're so far so good. The banking rules also state simply this: if you hold the investment to maturity, you do not need to mark on your books that the value of that investment has come down. Marking on your books is something that came out of the last crisis, which was 2008 and 2009. It's called mark to market, meaning that the risk managers and the credit managers of these huge institutions have got to mark on their books. And I don't know if it's every day, I doubt it, it's probably every month, something like that. They have to mark the value of their investment holdings based on what the market actually is going to pay for them. Not what they paid for them, but what the market value is today. That's mark to market. And that came out for visibility and transparency. That came out in 2008, 2009, actually closer like 2013. Okay. There's also a loophole in mark to market that says you don't have to market, you don't have to mark the investment to market value if you hold the investment to its maturity. So if you're sitting on a note on an IOU that matures in 10 years and you hold it for 10 years, you don't have to go in every month and say, well, now the value's up, now the value's down, now the value's here. You just have it. It's when you need to make money available. It's when the depositors or the companies that are invested in your bank or whatever it is, when people say, give me my money back, and you're only sitting on 10% of the total cash value of all the deposits that you took in, and you need to create cash, the way you do that, one of the ways you do that is you sell assets, just like you or I would. If I needed ready cash and I couldn't make it in my job or in my profession or whatever it is, couldn't borrow it from my family, couldn't borrow it from my friends, I would have to sell something and I would have to take what the market was paying. And that's where we are right now. There's a lot of these banks that have a ton of stress on them because at the moment they're fine, but if they need to get cash, they have to go somewhere to get it. And if they can't get it from somewhere, then they have to sell some of these assets. And if they're selling some of these assets, it's going to show on their books that they're taking huge losses. What that means basically is their stock price goes down, which means their market value goes down, which means their ability to get additional cash from other institutions or from other facilities or from other places, that also goes down. And all of a sudden it becomes this self-fulfilling prophecy. It's like an echo chamber. It just ping pongs around in there. And before you know it, the whole thing is whacked. And that's the concern. That's where we are looking into the abyss right now. And the reason that we're here, one of the main reasons, is because the Fed kept interest rates way low, way too low for way too long. And then when, they were asleep at the wheel, basically. And when the co-pilot gave them a good elbow and said, hey, wake up, all of a sudden they're like, oh, and they pulled back and they overcorrected. And now they shot up these interest rates, and the whipsaw effect is happening right now. And we're at the beginning of this, not at the end. So I don't know what's coming next. I'll be honest with you. I try to be as educated as possible. I try to be optimistic. I'm always optimistic. Whatever comes next, we'll deal with it. We always have, we always will. Like, what choice do we have, really? But I don't know what comes next. What's really scary is I don't think the Fed knows what comes next. Certainly our elected political officials don't know what comes next. Their only concern is getting reelected. And so that's kind of where we are right now. And we're watching it very, very closely. The good news is that inflation is coming down. That's great. And that is, from my perspective, that's a very welcome relief. We will see interest rates follow, and more things are coming down. The bad news is there's a lot of schizophrenia in the big financial world and in the central banks, which is what the Fed is. The Fed is a central bank, the European Central Bank. So here's an example of what is schizophrenic about all this. There's a huge and very old, very venerated bank out there called Credit Suisse, Credit Suisse. It's a Swiss bank, obviously. And they have been on the ropes with insolvency and a lot of problems for a long time. Insolvency basically means you owe more than you have, and you can't bridge that gap. And they were teetering on the brink. And so the the European Central Bank, I'm sorry, one of their investors, somebody within that, I think it's the Swiss government, pardon me for my lack of complete knowledge about that, but they just wrote a check for $54 billion to backstop and protect Credit Suisse. Okay, they needed to do that. At the same time, yesterday, the European Central Bank, that's the European version of our Fed, jacked up their interest rates by 0.5%. These are two conflicting storylines, okay? When you pump money into the economy, when you backstop banks, when you protect depositor or investor or company's money, and I understand it. I mean, I get it. I'm not heartless, but when you do that, that is what's known as inflationary. You're putting more money into the system, into the economy. So you're doing this on the one hand, but on the other hand, you're taking it back by increasing your interest rates at the central bank. So which is it, guys? Do we want to fight inflation, or are we trying to stop the world from just exploding with all of these weird investments, poor investments, unhedged investments, poor choices, basically? That's where we are right now. And that's where the central bankers are trying to figure it out. That's where the politicians, heaven help us, are trying to figure it out. Because I say heaven help us because I don't care who your political party is or who your chosen candidates are. They're always trying to kind of finesse in their favor and in their idea what needs to happen. None of them is an economist. None of them has really had experience dealing with this, and yet they're going to be grandstanding for their constituents. And I get that. I'm old enough to understand how politics works, but we're all stuck in this, right? You and I and people that have to work for a living, the people who aren't paid because of their political connections or because of their, economic pedigrees or whatnot. We have to make rent every month. We have to pay mortgages every month. We have to pump gas every couple of weeks or whatever it is. So we're stuck in the middle of this. And this is what's going on right now. I'm looking at my time. We got 2 more minutes on our 30 minutes, but this is exactly where we are. And it's changing minute by minute or day by day. And that is kind of the scariest part, because we're not out of the woods yet. We're still trying to manage all of this stuff. And there will be more repercussions of this. Again, you cannot just keep dumping spice into your dish and expect for it to come out a gourmet meal. Eventually, it's going to be either unedible or really horrible, or you're just going to order out a pizza or something like that. And we're going to find out together what's going to happen. Of course, I'm going to keep my eyes and ears on this. I'm going to continue doing my 30-Minute Thursdays. I'm going to continue. I can't believe it. We're coming up on 3 years of 30-Minute Thursday. As I think about the lockdowns and, 15 days to flatten the curve. That was the expression, 15 days to flatten the curve, how quickly we forget. But it's been 3 years almost since I've started doing these 30-Minute Thursdays, and I'm loving them. I hope you guys are getting value out of it. I will continue to monitor this. I will continue to study this, and I will continue to try to bring it to you guys in digestible format to explain what's going on. In the meantime, we're at that mark almost. If you have questions, please reach me. I would love to hear from you guys. I say it every time. I don't know if you guys watch to the end, but if you have questions, if you have comments, please, let's have a conversation. Reach me, email me, Facebook me, however you want to, courier pigeon, whatever it is. I'm analog. I probably get pigeons. But whatever it is, until next time, please stay in touch, stay safe, stay healthy, stay sane, enjoy your St. Paddy's Day, and enjoy the weekend. I will see you next week on Thursday. Thank you so much. Have a great weekend. Bye-bye.